Good morning, this is Dr. Finance, and you are watching Dr. Finance Daily. The air is thick with uncertainty this morning, and the tape is telling us exactly what we expected. The market is twitchy. We are seeing a broad-based rotation out of the high beta growth names and into, well, frankly, into nothing cohesive yet. It is a distribution phase, not a true correction, and that distinction is crucial for anyone holding a long-only mandate right now. The indices are singing a muted, slightly pessimistic tune. SPY is hanging just above 680, down 0.15%, but look at the Nasdaq under the surface. QQQ is off 0.5%, feeling the heat from the high multiple stocks correcting their excesses. The narrative is entirely dominated by sticky inflation prints and the corresponding hawkish pivot from every major central bank globally. They talked soft for so long, and now they are slamming the brakes. The market hates being told what it doesn't want to hear, and right now, the central banks are reading the riot act to over-leveraged speculators. We are seeing the necessary purging of froth, but the descent is proving to be anything but orderly. We must treat this environment with surgical precision. Chop is the killer right now. Let's cut through the noise and look at the scoreboard. SPY at 680.73, down 0.15%. It's clinging to levels established weeks ago, but the momentum bias is decidedly lower. QQQ, the benchmark for technological arrogance, is down 0.50% to 610.54. That underperformance relative to SPY tells you where the pain is originating. It's in the names that priced in perfection. IWM, the small caps, are showing relative weakness at minus 0.76% to 251.93. They are the canary in the coal mine for domestic economic health, and they are struggling to maintain altitude. When small caps show this level of bearish conviction, broader market stability is severely compromised. In the digital asset space, the story is one of consolidation under pressure. BTC/USD is clinging to $86,114, down 0.35%. It's not crashing, but it is certainly not showing the resilience we would like to see in a risk-off session. ETH/USD is significantly weaker, suffering a 1.26% drop to $2,926.91. The spread between the two suggests institutional money is retreating from the more speculative altcoin ecosystem first. Focusing on the big tech components that drag the indices, NVDA is the outlier, managing a meager plus 0.73% gain to $176.29. It's attempting to put in a bid, but the gravity pulling on its peers is immense. AAPL is cracking, down 1.50% to $274.11. MSFT, the stalwart, is down 0.78%. And AMZN, perhaps the most rate-sensitive of the megacaps, is showing significant weakness, currently trading at $222.54, a 1.61% decline. Volatility indices, though not explicitly listed here, are elevated, reflecting investor anxiety. The market is attempting to price in a higher terminal rate, and that repricing is causing significant dispersion in equity performance. This is where the real action is, or rather, where the real fear is being priced. The Treasury market is the bedrock upon which all equity valuations are built, and that bedrock is shifting violently. The 10-year Treasury yield, tracked by the $TNX, is critical. It's currently sitting at 4.18%, slightly lower on the day, down 0.29%. However, slightly lower masks the massive upward pressure we have seen recently. That 4.18% level is significant resistance acting as support. If we decisively break below 4.00%, it signals a potential, albeit temporary, relief rally in equities as the market recalibrates the path of tightening. But let's be clear. The overriding trend is higher yields, which means a lower present value for future earnings. The crucial diagnostic tool here is the yield curve. We are watching the spread between the 2-year and the 10-year. Aggressive flattening is occurring because the market believes the Federal Reserve will hike short-term rates aggressively to kill inflation, but that tightening will inevitably choke off economic growth, leading to lower long-term expectations. When this curve inverts, recession probability spikes. Currently, it is aggressively flattening, signaling that the market is taking the Fed at its word regarding inflation containment, regardless of the subsequent economic cost. This is the debt market screaming that the Fed is prepared to inflict pain. The dollar index, DXY, at 98.23, virtually unchanged, showing a slight intraday pause as global players assess the relative strength of the US tightening cycle against the ECB's tentative steps. The lack of strong dollar movement is providing minimal relief to international assets for now. The narrative coming out of Washington and Frankfurt is unequivocal. Inflation is not transitory. It is embedded, and we must react. The Federal Reserve consensus now involves multiple, non-marginal rate hikes. Forget 25 basis points, the market is now seriously pricing in 50 basis points moves, possibly back to back. Why? Because the Fed has lost face by being late to the party, and they must now demonstrate credibility, even if it means engineering a slowdown. Dr. Finance must tell you, the lag effect of monetary policy is long and complex. They are tightening aggressively now based on data that is already 2 months old. This increases the probability of an overshoot. They tighten too much, too fast, and trigger the very recession they are trying to avoid. The European Central Bank, ECB, is in a much tougher spot. They have fractured sovereign debt markets within the Eurozone, they have lower household savings buffers, and they are facing an energy shock. Any hike they deliver risks shattering periphery bond markets again. They will be slower, but the pressure from high imported inflation, driven in part by a strong dollar, forces their hand eventually. Expect the divergence in policy speed to keep EUR-USD volatile, though currently, the euro is showing modest strength against the dollar at 1.18. The takeaway for your portfolio is simple: assume rates go higher than you currently model, and assume they stay there longer than you currently hope. Commodities are showing fascinating divergence, largely driven by geopolitical stability and manufacturing demand indicators. Gold, $GC=F, is remarkably stable at $4,307.90, basically flat with a tiny gain of 0.03%. This is significant. In a rising rate, strengthening dollar environment, gold should be suffering more pressure. Its relative resilience suggests that while equities fear a growth slowdown, investors are simultaneously hedging against the long-term erosion of fiat currency value due to the massive monetary expansion that preceded this tightening phase. Gold is maintaining its role as the ultimate debasement insurance. Oil, $CL=F, tells a very different story, trading at $56.22, down 1.06%. This is a direct reflection of recession fears hitting the demand side of the equation. If the global economy slows due to rate hikes, industrial and transportation fuel consumption drops. The market is betting that the demand destruction from economic contraction will outweigh the supply constraints stemming from current geopolitical instability. This is a crucial signal. Fear of recession is currently outweighing the fear of scarcity in energy markets. Copper, the barometer of global industrial health, is not explicitly quoted in the snapshot, but weakness in energy and equities typically bleeds into industrial metals rapidly. Maintain skepticism on any commodity reliant purely on growth optimism. Where is the capital actually flowing when high multiple tech rolls over? We are looking for defensiveness, stability, and pricing power. The clear winner in this current rotation, based on the early session data, is healthcare. Healthcare exhibits intrinsic demand. People need medication, procedures, and care regardless of whether the Fed funds rate is 1% or 5%. Furthermore, many healthcare subsectors, particularly large-cap pharmaceuticals and medical device makers, have robust free cash flow, high dividend yields, and balance sheets strong enough to weather a higher borrowing cost environment. They are not dependent on massive future revenue projections, they are profitable now. Contrast this with technology, which is priced for 2030 earnings. When discounting rates rise, those 2030 earnings are worth dramatically less today. Healthcare offers a tangible present-day return with a relatively muted beta to the overall systemic risk of aggressive monetary policy. This is a quality play disguised as a sector rotation. Look for established names with strong pipelines and proven execution. Bitcoin stability is tenuous. $86,114 is a psychological holding point, but the weakness in ETH suggests the speculative lever has been pulled back across the board. For Bitcoin, the immediate support area is now defined by the congestion zone below the $85,000 mark. A decisive break below this level, and I mean a confirmed close below, opens the door to the next significant structural support, potentially testing the high $70,000s. Resistance is firming up around $90,000. Until we see conviction above the weekly highs, treat crypto as a high-risk asset class that remains highly sensitive to fluctuations in the dollar index and prevailing risk sentiment in equities. Do not mistake sideways consolidation for accumulation. This is exhaustion. We are operating in a reactive, event-driven tape. Avoid setting large directional bets based on morning momentum alone. The intraday reversals have been vicious. Strategy focus: short-term trading should be geared toward shorting rallies in overextended growth names, using NVDA as a potential but very volatile short candidate if it fails to sustain strength above its intraday levels. For the long side, position trimming in the most speculative parts of your portfolio is non-negotiable. Reallocate capital defensively. Seek those value areas we identified: healthcare, perhaps select defensive consumer staples, and anything with hard assets like infrastructure. Crucially, watch the opening hour volume on the major indices. High volume on down moves confirms bearish conviction. Low volume on down move suggests institutional selling exhaustion, which might lead to a midday bounce, a bounce you should use to reduce exposure, not increase it. Be disciplined on stop losses. The market environment demands ruthless risk management. The period of easy money is definitively over. The debt markets have priced in the medicine required to cure inflation, and that medicine is bitter. Those investors hoping for a swift pivot back to dovish rhetoric from policymakers will be sorely disappointed. They have committed to the fight. Your portfolio must reflect this new reality: higher cost of capital, reduced tolerance for unproven business models, and an appreciation for tangible, present-day cash flow. Stop looking for a V-shaped recovery. Start preparing for a sustained, grinding climb out of this trough. Resilience is not about surviving a 10% drop, it's about positioning correctly for the next 20%. This is Dr. Finance. Stay vigilant, manage your risk, and I'll see you tomorrow for the next Dr. Finance Daily.